All right, we are live and recording, and participants are filing in. Welcome, everybody. Thanks for joining very promptly. We're going to give everyone a minute to file in. We had a lot of signups today, and I can see a ton of people joining right off the bat. Appreciate everyone being nice and prompt. Um, as everyone files in, we'll give everyone just another minute or two to get signed in and on to the call before we get started. Wouldn't want anyone to miss too much. Good news is this is all being recorded, so anyone who's not watching live can see everything, and anyone who joins late can obviously watch the recording, which will get sent out through Netcapital's email later this week once it's all done. All right, we've got a ton of attendees already on board. I think we can safely get started. So thanks everyone for joining. Welcome to Netcapital's live Q&A session with Demand Derivatives. I'm Rob Burnett, the Director of Business Development at Netcapital. I'll be hosting today. As a reminder, Netcapital is a funding portal where anyone can buy and sell shares in private companies. And Demand Derivatives is one of the companies currently raising capital on Netcapital. So we have with us today Bob Kraus and Don Schlesinger from Demand Derivatives. Bob and Don, thanks for joining.
Yep. Hi, everybody. Yeah, I'm Bob Kraus here. I'm the CEO, and Don's the president.
Nice to be here.
Great. Well, as we get started, I know, Bob, you prepared a little presentation to kind of kick us off and get people acquainted with your industry. So why don't we start with that? If you want to share your screen and pull up the deck.
Yeah, thank you. Yes, so I just wanted to tell you a little bit more about our industry. This is not the pitch. You can go to the website, the Netcapital website and look at the pitch, and that explains more about the business and the problem. I guess what we're going to do is talk about the industry, but I guess a lot more about the problems that exist and how we're going to fix that. So in case you're not familiar with futures markets, this will be a nice quick primer, but hope you enjoy it. So let me start the presentation. Hang on here. Share the screen. Okay, Rob, do you see the screen up there yet?
Yep, we can see it.
Okay, and there we go. Okay. So I want to have a few minutes to give you an overview of the industry and the opportunities we face. I'm sure you've heard of the New York Stock Exchange, right? They are the largest stock exchange in the world. You may not be as familiar with the Chicago Mercantile Exchange. They are the largest futures exchange in the world. Okay, so stock exchanges trade stocks. Futures exchanges trade futures. Stocks are regulated by the SEC, and futures are regulated by the CFTC. Hang on a second. Okay, so Demand Derivatives will focus its effort on the futures side of things. Now, that doesn't mean we're leaving the SEC side untouched. We have a partner. We have licensed our products to a friend, our Box Options Exchange. So we're hitting both sides of the market with our products on our exchange, and then Box will be our partner on the other side where we're not getting our license. Okay, so let's step back for a second. So what are futures, right? Futures are financial instruments on typically commodities such as corn or cattle or coffee, sugar, cocoa, orange juice, crude oil, gold. And in the last few decades, they've expanded into financial products such as stock indices and bonds and foreign currencies. Here's a picture of one of the Chicago pits in their heyday. People would stand in these pits and buy and sell every day. Traders buy and sell with simple hand gestures and screaming. Everyone on the floor knows the GMO order, or get me out. Sometimes that order turns into a GMTFO order. It can be a very high-stress job, but markets have evolved, and for the most part, only a few pits are left. Now they trade on screens for the most part, sometimes lots of screens. Most interesting is that a very small number of exchanges control the vast majority of these markets. I think Stephen Wright said it best. The CME has a near monopoly in the US with 91% market share. The Options Clearing Corporation, they clear your options contracts in the US, and they have a pure monopoly, 100% market share. All options are cleared at the OCC. Warren Buffett said derivatives are weapons of financial mass destruction. Richard Sandor, the father of financial futures, said they're a positive force in the last 4 decades. So which is it? Are derivatives bad, or are they good? Well, markets are definitely good. How would a farmer sell his crops if there were no market? How many of you have car insurance or house insurance? Do you know that such a contract is a derivative? What are derivatives? Derivatives derive their value from something else. Insurance contracts are derivatives that derive their value from another asset, and that's called the underlying. Markets are good, insurance is good, then, well, so what's the problem? The biggest problem is default risk. Let's see how this works now. Suppose the full value of the contract is $20,000. The exchange might require, say, $2,000 margin to enter into that trade. What happens if we blow through that margin and you can't afford to pay? Well, do they send in Cousin Vinny? Well, no, but what happens if you cannot pay? Well, see, that's where the problems start. Here's an article that happened about a week ago or 2 weeks ago. Here's an example of a trader who had a $77,000 in his account and lost $9 million in one day. It actually didn't take him a whole day to do that. He lost $9 million in about 20 minutes. And this just happened last month when crude oil prices went negative. And it's not confined to a rogue trader or a simple guy sitting in his room or whatever. 2008, Bear Stearns went bankrupt, and Lehman Brothers filed for bankruptcy. And why? Essentially, it's because of credit, because of leverage, because of collateral deficiency. So how did we solve this? By changing the instrument design and limiting losses to the amount of collateral posted. In our case, if the trader posts $2,000, the trader cannot lose more than the $2,000 that he posted. How did we do that? By redesigning the instrument. The consequence is that it's much easier and much less costly to clear, giving us a huge cost advantage. The trader is happy because he knows his maximum risk up front. The broker is happy because he no longer has risk to his customers. And we are happy because traders should prefer our markets over the current one. How have the markets fared during the pandemic? They have had their best quarter ever. So we are attempting to transform the markets with 4 novel instrument designs on 6 major assets with an experienced team of over 100 years in this industry. We're trying to eliminate the customer default risk, trying to eliminate bank defaults, and definitely trying to save this guy. And bring this $10 trillion per day industry into a new age, providing an efficient and risk-controlled marketplace. So I welcome you to Demand Derivatives, and I guess that was the presentation I wanted you to see, and we'll pass it over to Rob now.
Perfect. Well, thanks, Bob. We appreciate it. So what we can do now is we've got some questions. You and I are going to have a discussion to kind of tease out and learn a little bit more about the product and the market and what you guys are up to. And then, of course, for all of the attendees who have joined, you're welcome to ask questions of Bob as well. At the bottom of your screen, there's a Q&A function. If anyone who's participating, any potential investors have questions for Bob and want to know more, please feel free to write your question in the Q&A function, and I'll ask it over the course of the presentation here and over the course of the discussion. So kicking it off, Bob, really appreciate the overview of the market and things like that. You touched a little bit on what you guys are up to, but why don't, at a very high level, why don't we start with just talk to us about what is demand derivatives and what do you guys do?
Okay, so demand derivatives is starting a new futures exchange and clearinghouse, and we're going after the big boys, going after those monopolies in this industry. We're not a crypto exchange. We're not trading cryptocurrencies or whatever. There are over 400 crypto exchanges, so we're not competing in that space. We essentially have one competitor, or essentially two competitors. And so that's the space we're going after. And we figured out by creating these new instruments, going after the low-hanging fruit, so to speak, the top 6 assets. By the way, I didn't say, but those top 6 assets account for 35% of CME volume. They have thousands of instruments and assets that they trade, but 35% are just those 6. So we're going after those 6, trying to make our mark there, and then we can talk about expanding into other assets. But we're starting our own futures exchange and clearing.
Great. And you mentioned cryptocurrency, and I know that was probably an allusion to the fact that you use blockchain technology, which I want to circle back to in a minute. But before we get there, you mentioned that your team has over 100 years of combined experience. Can you talk to me a little bit about the team, go in a little more detail, and how you guys all came together to start this?
Okay, so quickly, we have a board member from the Federal Reserve. We have a Fed official on our board, and we have an exchange executive on our board. There was the BATS exchange, which was taking on New York Stock Exchange. Jeremy Johnson, he's on our board too. Andrew Kumiega is right now an advisor, but we're planning to bring him on as the COO. He is an industrial engineer, very well regarded in this space. He also teaches at IIT. He's a professor there. And then Don, he doesn't like to brag about this, but I thought it was amazing that he was offered the job of being head of global risk for Deutsche Bank, and he turned them down. So he came to work with us. We have an amazing team. Wendy Robinson, our general counsel, was at the CFTC and the NASD, also at several investment banks, all, in the past, all gone now, but, E.F. Hutton, Payne Weber, they were all kind of swallowed up by bigger firms. But it's one heck of a team that we have. I mean, everybody puts together a great team, right? But I can't think of anybody else that I would have wanted on our board besides these guys.
Great. And so let's dig into the solution a little bit. So you said you're creating a new futures exchange. Can you talk to us about, you mentioned 4 new instruments. Can you kind of walk us through what those instruments look like? And then after that, I'd love to talk a little bit more about kind of your use of blockchain and how that works and fits into your new model.
Okay, yeah, Don, why don't you tell them about the instrument?
So one of the hallmarks of everything that we're trying to do is that we have patented instruments, a variety of them, a suite, if you will, that are novel. They simply have never traded before on any exchange. The first one is a realized volatility product that we call Real Vol. And the concept is very simple. These are futures contracts that settle to a calculation of realized or actual volatility of an underlying asset. Some listeners might be familiar with VIX, which is a product that trades on the CBOE and that settles to what is known as implied volatility that's derived from options prices. But ours is realized volatility, which settles to the actual demonstrated volatility of the underlying asset on a 21-day basis of closing prices. So this is a very important metric to understanding and quantifying risk, and having the ability to trade risk itself through these volatility contracts, or real vol, opens up an entire new frontier in controlling the systematic risk of a portfolio. And we're very excited to bring that concept to a listed exchange. The second one we call real day. These are 1-day options, calls and puts on any underlying asset, but that are going to be what we refer to as forward starting or delayed strike. You can buy them a couple of weeks before they become active, but they actually come to life on the eve of the expiration day. So you have a 24-hour period to trade these particular options. And this has been the trend in the industry. Used to start with options that had 3-month expirations, and then they shortened them to 1 month, and then they had weekly options that have garnered a huge share of market volume and became very interesting and very important. And now we have the concept of bringing it to the logical conclusion, a single day. You can target an exposure for one particular day. Could be the election or the day after. Could be the Fed is going to hold an important meeting. Could be the day of earnings announcements for underlying stocks, where the volatility or the movement of that stock can be considerable if it disappoints or if it exceeds expectation of earnings. So in terms of a product that's needed in the industry, we find this to be a logical extension of the shortening of the time period that people hold options. In terms of an opportunity for investors, a 1-day option is very cheap. And so the idea is that traders are going to want to buy a lot of these, and they're going to want to trade them from one day to the next, which creates a wonderful opportunity from the exchange point of view to have a wonderful revenue stream through the ability to trade these options on an ongoing daily basis. The third product is one that we are probably going to roll out a little bit later than the inaugural date of the exchange. We call it Real Globe. And the concept is to trade listed options and futures on a single exchange, but that are trading the world's futures contracts. So consider that we in the United States have several futures contracts for stock indices, and all over the world, they are trading these listed futures and options on the various local exchanges. We're going to centralize all of that on one single exchange, which will allow for dramatic cost reductions, capital efficiencies, ability to spread between different countries. I want to be bullish on Great Britain, but bearish on Japan. Well, you don't have to worry about currency exchange rates. You don't have to worry about going to the local markets to trade. Everything will be centralized on one exchange. So a very exciting concept. And then finally, overlying all of our products will be both a concept and a product, and that is what we call real limits. Bob alluded to it in the presentation. The real limit concept has never been applied before on any listed futures exchange, and it will allow people, traders, investors, to trade futures contracts, but with a predefined limit or risk. So you define how much you want to risk, either to the downside or how much you want to make to the upside. You post that amount of collateral, and should you touch that limit up or down during the course of the day, you are what we call stopped out, and you are cashed out at that particular limit. So the concept of allowing a futures contract to go only so far and then be stopped out at a particular predefined limit of margin or collateral is brand new to the industry, has never been done before. So these were created to reduce the risk to traders and to eliminate the systemic risks to exchanges and clearing firms and futures commission merchants that Bob alluded to in the presentation. This concept of the limit can apply to every one of the products that we're going to trade, and will be a product in and of itself applied to futures contracts. So a lot to be excited about and a lot of innovation at the exchange.
Don, following up on that, can you talk a little bit about how limiting the downside risk affects the upside risks of these, or the upside potential of these instruments?
So we have actually been experimenting with different concepts, because with a lot of investors, we understand that there's a precept on Wall Street that says, you know, cut your losses, but let your profits run. And so we know that sometimes an investor would like to predefine a limit for the loss, but perhaps would like to allow profits to run a little. We have spoken about the possibility of not only having symmetrical limits, make as much as you would lose, but perhaps allowing a multiple to the upside that would allow you to allow the profits to run while still defining a predetermined loss. So depending on the instrument, depending on the volatility of the instrument, we're going to explore the possibility of having different upside limits compared to downside limits.
Yeah, and the one thing I just want to add to that is that it is designed and it works well for one-to-one. You know, if you're risking 2,000 on the downside, we can match you with, you know, 2,000 on the upside. And Don's just talking about potentially we're going to try to increase the upside. So that's where we're at with that.
Great. And we have the first audience question, and I think it fits in well right here. This is from Tossin. I'd like to know what the target market share is for your firm in this space. What is the level of risk in terms of profit and loss for your business? And do you have strategies in place to minimize losses from bad trades? So I know that's three questions kind of bundled into one. I'll let you guys start, and if we need a refresher, let me know.
Well, give me the first one again.
What's the target market share for your firm in this space?
Well, that we can't answer, right? Because that's an SEC requirement. That's we can't talk about how wonderful our firm could be or what kind of projections we're going to get to. You know, talking about shares or, you know, potential is sort of a no-no. Sorry.
maybe instead of talking about what market share you want to capture in the space, can you talk about some of your competitive advantages and why you think you'll steal market share at all?
Well, you know, with Don pretty much summarized it very well. Because of the new instrument designs, we think they're going to take market share. But actually, this gives a good intro. So, for instance, the real day. So let's go back to weekly options. And as Don was saying, weekly options have been very successful, and they're very successful because they target exposure now to a much narrower time frame of a week. And those options started with zero about 8 years ago, zero volume. And now they're more than 50% of the market. So this is one of the most successful products ever. And so now we're going after the daily market. Now, whether we can get that, you know, that kind of success, I'm not sure. But, you know, the fact that the options are much cheaper being daily. If you know anything about options, you know that the time frame, longer time options are more expensive. So obviously shorter time options are less expensive, and daily options are really cheap. So that would generally, I would say, portend to somebody, if they have a certain bank account, they'll put more money or buy more daily options. But also they expire every day. So then if you just wanted, let's say 5 days, to compete with a weekly option, you got to buy 5 of these. So the volumes there could be big.
Okay, and then the next question was, you can talk a little bit about what's the level of risk in your business in terms of profit and loss.
In our business, okay, we're not trading, so I'm not sure if you're talking about it sort of from a trader's perspective or like a hedge fund. I know some people think that we're managing money or or something like that, and because that's what the question sounds like. But the risk in our business generally, we're coming out, we're the exchange, right? We're the intermediary, we're the place where everybody gathers and then the traders trade, right? And so we don't have any risk per se to the market. We take a small fee for every trade that we're projecting that's going to be about $1.50 per contract. So as far as that goes, there's no risk, but obviously there's risk to the business, right? Getting the license and getting the technology installed and, all of those kinds of things. But I am not sure that kind of is the question he was asking.
Sure, and the third part of his question, which I think you answered, but let's just to close the loop. Do you have strategies in place to minimize losses from bad trades? Is that something that Demand Derivatives has to worry about?
Yeah, no, see that's kind of what the tip-off was there. We're not trading at all. We're not, forcing the market one way or the other. We're making the venue available for traders. So we're just taking a cut of the fees, almost like a bookie tries to, balance the thing. But we don't even have that risk, right? We're matching people. They're already a buyer and a seller. We're matching them together and taking a $1.50 for the privilege.
Great. And we have a second investor question, and this circles right into what we're talking about now is how does Demand Derivatives receive revenues from commissions or percentage of cost of trades? I know you just touched on it, but I wanted to let you answer it directly.
Yeah, so the per contract fee, we're actually expecting to be about the same as the CME. So they're all over the place. So there are quantity discounts. There are discounts for members as opposed to retail. There's different prices for different instruments. So it's really all over the place. But a good kind of rule of thumb is about $1.50. And so $1.50 is a good good ballpark for what we expect to charge. The interesting thing is that futures commission merchants, these are essentially the brokers that you work through, they charge roughly $1.50 a contract. Again, that's a ballpark, because they're all different. But we don't need futures commission merchants. So the fact that we're cutting out those participants, we don't need them because they are there to essentially guarantee your trade, and they take a cut to provide that service. And so we don't need a guarantor. So you're cutting your total cost in half if we were to charge the same fees as the CME.
I think it's important for listeners to understand that every trade that's initiated when we talk about fees multiplies rather quickly. You open a trade and you initiate a new position. Person who initiates that, there is a fee. Person who's on the other side of that trade and who also initiated, let's say one is the buyer, one is the seller, there's a fee that's incurred there. Now you have an open position, and very often, rather than wait for the contract to expire a certain number of days or weeks in the future, someone closes out or ends that position that was open. So that's another fee in order to do that, and somebody on the other side of that. So in a manner of speaking, every time somebody has the idea to initiate a trade, down the line, you're actually generating 4 such fees. And it goes without saying that once you start to generate volume, those fees can add up to something appreciable.
Great, thanks. There's a follow-up question from the same investor. What is your estimated total addressable market? Will this be a national market or a global market in your anticipation?
Well, we're starting nationally, so we're starting in the US based on global assets, so corn, crude oil, gold, you know, stock index. Well, I know it's the S&P and that's a local, but you know, pretty much the S&P is kind of a global benchmark because it's, you know, we're 40% or whatever of the world's assets, right? So that's a huge chunk right there. And then we're talking about a foreign currency like the euro. So it's traded here, but you know, we're talking about an FX transaction. So we're really talking about global assets traded locally. We didn't talk about our future expansion. You know, after we open a US exchange, the long-term goal, or phase 3, if you will, is to then try to open up 2 other exchanges, one in Europe, one in Asia, and then have a truly 24-hour marketplace.
Great, thanks. And we have a bunch of investor questions coming in. This is great. Thanks to all the participants for asking such great questions. Please keep them coming. Another question is, hello, the recent spike in Robinhood users and commission-free trading with other firms following suit, how does that impact your business model? So how does the commission-free trading of stocks affect how you guys plan to operate?
I think actually it's perfectly fits into our model. And the reason is the Robinhood thing is for stocks, right? So remember my presentation, we talked about the stock side versus the future side. So you know, Robinhood is really stocks and investing. Futures is really for trading and risk control, right? Trading, like, I mean, like a farmer getting, you know, what am I doing with, you know, thousands of bushels of wheat, right? They need to trade it for money, right? Et cetera. So I didn't mean trading like speculating per se, but that's what I'm talking about. The model that we're coming out with, where we charge the same fee as the CME, but what we're going to do is give up to half of that for volume to the broker for bringing in clients. So you know, Merrill Lynch or TradeStation or Interactive Brokers or whatever, those guys could offer 0 fees to their customer, but still get paid from us by us charging, you know, the standard fee. And how can we do that? Because our clearing fees are so much less. So we've reduced the cost to clearing by about 90% compared to an exchange like ICE or the CME. And because we've lowered our costs so much, we can cut the cost to traders by half, and therefore we think that they'll, you know, join us. And the business model, though, is to give them that half cost savings by charging them the same exchange fees, 0 broker fee, right? So it used to be about $1.50 and $1.50. Now it's just $1.50. And then out of that $1.50, roughly half of that will go back to the broker. And so he'll make a little bit less. We'll make half as much as the CME, but they'll make a little bit less and have no risk. So that's a big factor, right? They're still making money, but they're not risking any. With the current system, that $1.50 covers like default risk, essentially, because the broker's on the hook. If you remember my first presentation there, if you blow through that $2,000 margin and you have to come up with another $2,000 and you pull out your pockets and say, I'm sorry, I don't have it, who pays? Your broker has to pay. So the way the system's set up, your broker has risk to you and your positions in that scenario. We're saying, okay, we're eliminating that risk to you and we'll still pay you half. So that's how we're going to get clients.
Great, and we've got a couple of other questions coming in, but before we get there, you talked about reducing your costs, and one thing I wanted to circle back to was your use of blockchain technology to reduce your costs. So can you talk a little bit about how you use blockchain and why that's able to benefit your business?
Okay, so we're using blockchain, let's say tiptoeing into blockchain. Okay, this is a little bit different, and I guess it goes back to the definition of blockchain. What is the definition of blockchain? It's a distributed ledger, right? Well, we're not distributing, so it's just a ledger. Okay, so it's not that innovative. But what that does is it offers us a bunch of advantages. One thing is that we have an immutable, we're using the format, but not the distribution part. So with the format, we get an immutable record of trades. We can't go back and change a trade, for instance. So regulators love that fact of the blockchain. But because we're not distributing it, it's instant. We don't have to worry about the network updating, so it's much faster. And if anything needs to be changed or updated, we can do that, on the fly or almost instantly, as opposed to, getting all of these network nodes, et cetera, all updated correctly. And I think a nice feature is that our clearinghouse is then, I don't want to say bulletproof, but what do you call it? Like ready for the future, I guess. Because if we ever decide to distribute the ledger, I mean, all we got to do is start distributing it. So it'll be done. We don't have to reconfigure the whole clearinghouse. So there are a lot of advantages to how we set it up, but it's not blockchain in the strict sense that everybody's used to.
Great, and we had a question from a Bill, who's one of our participants. Can you talk about regulatory issues as an exchange? What stage are you in terms of registration? And if not yet registered, what is the timeline and key milestones that you need to meet? Do you require innovative instruments? Do the innovative instruments also require regulatory approval?
Okay, yeah, excellent. This is great. So we have to apply to the CFTC, that's the Commodity Futures Trading Commission, to be a designated contract market and a designated clearing organization, essentially being a futures exchange and a clearinghouse. And DCM, designated contract market, and DCO, designated clearing organization, are the two regulatory licenses. I'm not sure it's a license per se, regulatory approvals that we need to be a futures exchange and a clearinghouse. Now, this isn't like a drug trial or something where, there could be a bad side effect and the regulatory then says, no, I'm sorry, we're not approving this drug, right? With this sort of thing, you can be rejected, but they tell you why you're rejected. And then if you go fix those things, then you get your license. I mean, it's, as long as we go and do what they tell us that we have to do, we should be able to get the license. So as far as that goes, I think the risk is very low that we wouldn't get a license. Anything's possible, so I can't say that it's zero, but that's that. And there was another question about this, Rob?
The same investor and one other investor had another question, slightly different, about market share. So who is the market that Demand Derivatives is trying to win over? Are they existing traders or a new market of options day traders? And then, in addition, are you competing for the same traders that are on other exchanges? Who are your target clients? And then what level of volume will you need to create sufficient liquidity on the exchange?
Wow, that's a lot. So,
I'll keep circling back.
yeah,
I think the first
okay.
question is, who's the market? Are you looking
Right.
for existing traders, or are you trying to add new ones, or both?
So generally, the market is institutions. We're going after the institutional market, just like the CME is. There are a couple of small competitors that are going after, let's say, retail traders, guys that want 1 lots and 2 lots, and have maybe a few $1,000s in their account and trying to speculate or something. We're going after the big boys, the big players in the market, investment banks, institutional hedgers, pension funds, insurance companies, et cetera. So the target market of the CME is our target market. How would we get those? We're going to get them with better risk control, lower costs, and frankly better products, I think, because they offer different kinds of risk control, right? The realized vol that Don was talking about, there is no volatility product at the CME. So we would be the place if you wanted to get realized volatility. You can't get realized volatility there. They don't have daily options. So you want daily option exposure, you have to come to us. You can't go to the CME. You want limited risk futures, or define your risk specifically, you have to come to us, because they don't have those at the CME. We have patents and patents pending on our instrument designs, and so that's where we think we have a competitive edge. What was there more to that?
The final part to the question is, what level of volume do you think you'll need to create sufficient liquidity on the exchange?
That's a tough one. I don't know the level per se, but here's the mantra that I think would help you get a handle on this. If we can build from some volume, we can't build from no volume. So the worst thing to do is to launch the exchange with a bunch of zeros or blank screen or whatever. If there's some volume, then we can build on that. And obviously, if it's just a little some volume, that's harder than more. But this is almost like a hand crank engine, right? Those old-fashioned propeller planes that back when they first, Orville and Wilbur kind of thing. So you have to kind of force the market to start. And so we have to provide incentives, cut fees, that kind of thing, and get market makers and get people there in the beginning to start the market. You got to kind of force it to go. And as soon as you get some volume in there, then we can build from there.
Great. And just so, thanks again, everyone, for all of the great questions. We've got a couple more in the pipeline here. We're coming, towards the last quarter of our time here. We have about 15 minutes left. So if anyone who's listening has more questions, please throw them in now, and we'll keep working through them until we can get through all of them. We have 2 investors asking the same question: is, can you circle back with regards to timing of approval and licensing by the CFTC, and kind of what's your timeline for getting launched?
Okay, that's a good one. In fact, I think the first guy asked that, and we forgot that one. So the official whatever edict or whatever from the CFTC is 180 days from the time you apply, assuming that everything's correct and set up the way they want and paperwork's all done right. It takes them 180 days to approve that. From our past experience, it doesn't happen that fast. So we're giving them an extra 3 months, and we're kind of targeting or hoping that we get our license within 9 months of being funded. So when we get full funding for our Series A, which is this crowdfunding side-by-side offering that you can look on Netcapital for the amount, I understand that I can't say the amount. I don't know, but whatever. You'll be able to find it on the Netcapital site. So when we get full funding, then from that point on, about 9 months. We actually don't need the full funding at that time, because 2 million out of that, the asking price is set aside for next year's or the following year's operating capital. This is a CFTC requirement. So when they give you the license, they want to know that you can operate for at least a year, that you have enough assets in the bank to do that. Now, that's just from the license standpoint, about 9 months. We could be ready in 6. We have scoped out a whole project plan, et cetera. If we had to, we could be ready in 6. Now, we don't need to rush if we know that the CFTC is going to take longer than that. But our point is that we can be ready internally with our systems, testing, marketing effort, IP, all of that stuff within 6 months. So we're shooting for 9 months to launch. If we were to get funded today, then we're talking about, probably February or March next year. Great.
And there was another question that seems more directed towards me, so I'll answer it quite quickly. An investor asked about doing a Reg D 506C. And so Demand Derivatives is currently doing a side-by-side offering live on Netcapital using both Reg CF and Reg D 506C. So they're using both exemptions on the Netcapital platform. So the next question we had is actually a lot of our attendees think alike. We have 2 different attendees asking, why wouldn't the CME or other futures exchanges just add the same type of trades to their customers to compete with you? And then the second asked a similar question, what precludes existing exchanges from implementing similar concepts? Is it IP and patents?
Yes, exactly. So we have filed, we have 8 patents or patents pending on our instrument designs. On one of those instruments, the CME didn't like that or wanted it or wanted to destroy it or whatever, and they challenged our patent. We were successful against that patent challenge. They didn't like that answer, and a few months later, they challenged our patent again. We were successful again in defending that challenge. So we've gone through this twice now. They definitely know we exist, and we survived. So one interesting point about this, though, is really we just need the patents to get started, kind of prevent them from preempting us or prevent them from kind of starting and doing exactly what you're saying, side by side, coming out with something different. Our patents are written fairly broadly. The patent office is trying to get you to focus in on exactly what your patent is, and we're trying to patent everything in the world, kind of thing. So there's a kind of a push and pull as far as that goes, but we're trying to make it as broadly as possible to patent, essentially any kind of futures contract with a limit. So there are some, some, as I said, pushback there, but in general, we have patents on realized vol that really can't be, unless the patent gets thrown away or whatever, gets disallowed, or really you can't trade realized vol without kind of stepping on our stuff. Kind of the same thing with real limit. So we think we're fairly well protected there. And as I was just saying, we really only needed to get started. These markets, just like the CME, the reason why they have this monopoly is it's very difficult for a new exchange to start trading gold futures, for instance, in the normal manner, because the market's already very liquid at the CME. Why switch to an illiquid market? The cost there is just too high. But when you're offering products that you can't get there, okay, you can't get volatility, you can't get a daily option, you can't get limited risk futures, right? So that's going to attract some people who say, I need that, right? And then, like I said before, we can build from some volume, we can't build from no volume. So now you attract some people that'll say, oh yeah, you know, the bid-ask spread is kind of wide, but I really need that, right? And so you know, we start attracting people because they need that. And then, you know, it starts building, and then as you grow volume, that bid-ask spread comes down, the costs come down, and we get to be a liquid market. At that point, when we're a liquid market and a liquid competitor, we don't really need the patents.
Great, and there's a somewhat of a follow-up question here. Will you have other generic instruments on your exchange, or will only be the 4 you created? Does the CME or other competitors have patents on certain instruments that give them a competitive advantage?
The Chicago Board Options Exchange may have a patent on their VIX product, but I don't believe that the CME has instrument-like patents that, or at least none that are, you know, liquid and you know, really viable. They may be trading. I don't know if they have some kind of esoteric thing that's trading on the exchange, you know, trying something new or whatever. But for their main products, you know, the products we're going after, the assets we're going after, they don't have IP on that stuff.
And are you planning on having generic instruments on the demand derivatives exchange as well, or is it only going to be your proprietary instruments?
Right now, the focus and all of our efforts are on our proprietary products, and we're going to launch those on many assets. I said 6, but that's just sort of the start, and that gives us a good, let's say, indication or feel from the market. You know, the market might say, wow, I really love your realized vol on equity indices, but I don't know, none of the farmers or whatever care about volatility on corn. Okay, well, we're not gonna start then trying to roll out volatility on wheat and soybeans and stuff like that. We'll focus our efforts on, you know, other indices or other related equity index markets, right? So the 6 products that we chose are the biggest asset in each asset class. And so that's going to give us a real good feel for which of our products work on which asset class. And then we can go from there and try to build the market and let the market tell us, you know, what they like or what they want to see, or, you know, it's half giving them sort of the best product we can, and then half listening to them as to, you know, what they want to see and how to tweak it.
Great, and we've got a couple more questions here. If anyone's got some final ones, please put them in. We've got about 5 minutes left, so we'll try to knock through the rest of them as quickly as possible, but you appreciate everyone's great questions. So yeah. While we're here, to get some volume started initially, do you anticipate being on the other side of some initial trades?
No, the answer is no. We're not market makers. We're not devoting capital to that effort. We are just, you know, we'll try and get market makers. We will try and get institutions to come in and be the other side of these trades. And I think we'll be successful. So far, we've gotten a lot of good indications, but no, we're not market makers. We're not taking risks per se, like price risk, you know, market risk like that.
Yeah, and the same investor had another question. I believe this was asked in the context of talking about your competitors, the CME and others. Could they pay you a royalty for using your instruments?
Well, that would be a license, and we do have a license agreement with Box Options Exchange. They are, if you were here, I don't know when you joined, but if you were here in the very beginning, that was pretty much the first slide. And we were talking about that we're on the CFTC side of things, and Box is on the SEC side of things. And so we are licensing our instruments to Box, and then we are retaining the rights on the CFTC side. We have no plans to license or get royalties or whatever from the CME. We're going to, you know, retain those rights ourselves.
Great. One attendee, I might anticipate this question saying that, projections aren't really something that we can talk about. But one attendee asked about what are your revenue projections once you go live. Maybe you could just talk a little bit about kind of how you're going to generate revenue, things like that.
Yeah, so I mentioned it a little bit with our per share, or not per share, per contract fee of roughly $1, the same as the CME. So if we have $1.50, we're going to charge about $1.50, but that'll be about half in total cost because there won't be the FCM, the futures commission merchant, the broker fee in there. So so roughly the cost will be half to the client, but we'll get those fees and share half of that, up to half of that with the broker. That'll be the main source of revenue. There could be other sources of revenue such as data sales. We have indices like realized volatility indices. We will try to sell those. Those are generally the two fees that you would have. Yep.
Great, and we have two investors asking the same question that I think is going to be great up on. So we have two investors asking about: are you even kind of thinking about an exit strategy at all at this stage, and what would?
Yeah, Rob, you were cutting out there, but
apologies. I can ask you one more time.
Yeah, I think you should. I got the gist, but
No problem. Can you hear me now?
Yes.
Great. So the question from two attendees was, are you even thinking about an exit strategy at this point? And if you were thinking about exit strategies, what types of things do those look like?
Yeah, so right now there's no plan for an exit, partly because this isn't, let's launch the 6 contracts or the 4 contracts on the 6 indices, and then, then it works and let's sell it and, turn it into, a cash cow. Essentially, the CME is a cash cow. They really aren't bringing out new and innovative products. They're just trying to, on the margins, get a little bit more revenue here, a little bit more revenue there. We have such an expansive market. Those 4 instruments could be placed on hundreds, thousands of assets. And with our phase 3 expansion, which I mentioned before, of trying to launch a futures exchange in Asia and in Europe, that's going to keep us busy for a long time. And so we have hundreds of potential instrument or assets that we could launch our instruments on. We have 2 exchanges that we could open up in other parts of the world to actually make it a 24-hour, almost like an airline alliance, right? It would, these 3 exchanges would kind of work together, make sure that you can, transfer from one to the other, but in different time zones with different, not everybody can trade at 4 in the morning, right? So it, just opening our exchange 24 hours is okay, but it really doesn't bring in, overseas investors, as well as having an exchange in a local jurisdiction, trading, settling in a local currency, and during the hours that they're open. So this is a long-term project. One way, but what, like, embedded in that question though is liquidity, right? How am I going to get my money out, right? So one way is through the Netcapital platform, right? Rob, you can explain that they could actually, after a year, I think it is, they could sell their shares. We may go through an offer to buy shares back, like companies do. I think that would be a great thing in the future. But this would be a long-term investment, and hopefully you'll see the benefits over a long period of time.
Great. Thanks, Bob and Don. I think that's a great place to wrap up. We're coming right to the end of our time here. Thanks everyone for joining and asking a bunch of really great questions. Thanks again, Bob and Don, for joining. Reminder to everybody, Demand Derivatives is currently raising capital on Netcapital right now. Anyone who's listening can go and invest. It's netcapital.com/companies/demand derivatives, and you can find it right there. You can also find the link in the invite to this presentation. We'll send around a recording. And if anyone has additional questions for Bob, Don, or anyone at Demand Derivatives, you can ask that question on the discussion board on Demand Derivatives page on Netcapital. So with that, again, Bob, Don, thank you so much for joining us.
Thank you.
Well, I really appreciate you guys all being here, and thank you so much. We're very excited about this project. It is a long-term project. You'll hold your money will be locked up for a while, unless you can do the liquidity thing with Netcapital and the secondary offering. But I think you're going to find this really, really exciting. It would have been great to buy the New York Stock Exchange or the Chicago Mercantile Exchange when it first started, right? So it has potential. I guess that's about the only thing I can say as far as SEC rules. So thank you so much. Really appreciate it. And the minimum's low, so we'd love you to be a part of it.
Fantastic. Well, thank you, everyone. I hope everyone stays safe and stays healthy, and hopefully we'll see everyone again soon. Thanks again, guys.
Bye, everybody.
Bye.